Hello, I'm David Cheston with 90 at 9, brought to you by interest.co.nz. This week, get everything you need to know in 90 seconds at 9 o'clock. With news, emerging markets are struggling to contain their pressures. But first, we should note that Wall Street is closed for their Labor Day public holiday. Yesterday, most markets in our time zone closed lower, including our own, and there is anxiety over what the New York markets will signal in September. The very long bull run will end at some point, and memories have faded on how these things turn. Overreaction is a common outcome. The OECD is pointing out that global financial risk is high, with interconnectedness through high levels of financial derivative exposure, as high as was just prior to the GFC. They also want global standards to manage and restrain cross-border infrastructure investment, like that of China's Belt and Road Initiative, pointing out the extreme risk building for emerging economies through China's shadow lending. They see the current Chinese track based on corruption, a lack of transparency, ignoring environmental risks, and a twist to the dominance of state-owned enterprises. Surprisingly, China has responded quickly. Overnight, President Xi has promised Africa debt relief. And Argentina has announced austerity measures in a bid to tackle the emergency created by the country's currency crisis. Their president said they could no longer keep spending more than they earned. He announced new taxes on some key exports and said about half of the nation's government ministries will be abolished. Their gamble on gradualism with IMF support clearly didn't work, and they've been left with few choices. The currency situation in Indonesia is not looking too flash either. In Turkey, inflation has leapt to 18%, an all-time high, and up from 10% in March. Their central bank has promised action to restrain it. Their official interest rate is currently at 16.25 and is likely to rise substantially and soon. Manufacturing activity in Mexico expanded more slowly in August, but still expanded. In Brazil, their rate actually picked up, moving from a contraction 2 months ago to expansion in August. And in the Eurozone, they're recording a slowing in their relatively high rates of factory activity. There's now a run of expansion that stretches back 62 months. But the latest data is slowing growth, and it's the slowest since November 2016. In China, the private Caixin General Manufacturing PMI slipped to 50.6 in August from July, marking the third straight monthly drop and its lowest level since June 2017. And it has come in lower than analysts were expecting. The sub-indexes for new orders and output both expanded, with the former falling and the latter climbing. This showed slowing demand and strong supply existed at the same time across China's manufacturing sector. This PMI reading is more cautious than the official government one. And the US Treasury 10-year yield is unchanged at 2.86%, with their two-turn curve still at 23 basis points due to the US holiday. The Aussie government 10-year is at 2.52%, that's also unchanged. The Chinese government 10-year is at 3.61%, up 1 basis point, while the New Zealand government 10-year is at 2.55%, down 1 basis point. And gold is unchanged at $1,201 an ounce. US oil prices are marginally firmer, now just over $70 a barrel. The Brent benchmark is also firmer at $78 a barrel. Questions over Iranian crude oil supply after sanctions are keeping the market well bid. And the Kiwi dollar is holding lower at 66 US cents. On the cross rates, we're also lower at 91.6 Aussie cents and softer at 56.8 Euro cents. That puts the TWI at 69.8 and a 3-week low. I'm David Cheston. That was 90 at 9, brought to you by interest.co.nz.